Welcome everyone to today's webinar. I'm glad that you could join us today for an update on HRA plans and creative plan design solutions. This webinar is part of ProBenefits client webinar series in 2014. I am Chris McCauley. I'm a benefits attorney at ProBenefits, and I'm also joined today by Jamie Rohr, who is a benefit consultant here at ProBenefits as well. Just a couple housekeeping items before we get started. As always, the slides will be available after the presentation. We will email all attendees with a slide and a recording of the audio, so that will be available. Also, you can ask questions today during the presentation. On the control panel on the right side of your screen, there's a question box, and you can use that question box to answer questions that we can answer. And we should have time at the end of the presentation to answer the questions. Anything that we do not get to, we will certainly respond to you with an answer after the presentation. So feel free to ask some questions, and we will get to them. Just an outline of today's session. You can see we are talking about HRA's health reimbursement arrangements, and so we want to touch on the basics, give some compliance updates and some updates on common plan designs and new trends we're seeing in the marketplace, and then at the end we will answer your questions. So let's jump right into the content. We have a lot to cover. So let's start with the HRA basics. Health reimbursement arrangements are excluded from income. Reimbursements and coverage under the HRAs are excluded under IRS Code Sections 105 and 106. What you'll see as we go through and talk about HRAs is the biggest key to HRAs is flexibility. Flexibility in the amount of contributions that an employer can make, flexibility in the types of expenses that are covered, flexibility in the types of plan designs that an HRA can help an employer provide benefits to employees. So, so there's many variations on a similar theme, and Jamie will get into those variations towards the second half of the presentation. The biggest foundational principle for HRAs is that they are all employer funded. There are no employee contributions. And so that's what makes an HRA or an HRA is that they are funded entirely by the employer. Again, as I said, all qualified reimbursements are non-taxable to the employee and fully deductible by the employer. There's three basic plan design models, and Jamie's going to get into these more as we go on, but deductible reimbursement plan, which is by far the most common, which typically reimburses deductible or co-insurance expenses that are linked to a group medical plan. There's also a medical expense reimbursement plan, which typically just reimburses one type of expense, be it dental expenses or vision expenses. And finally, a full health reimbursement arrangement, which is essentially a large bucket of money which can be used to reimburse any medical expenses allowed by 213D of the IRS code. But again, Jamie's going to get into those types of plans as we move on. But again, the key is flexibility. So as we move to the next slide, I think we just wanted to start off and touch on some of the legal requirements, the compliance topics for HRAs. And here on this screen, you can see the four main bodies of legal requirements for HRAs. The four sections of law which outline the HRA compliance issues. And the first is, of course, the IRS code and IRS regulations. And just hopping hopping into some of those requirements. So the HRA can only reimburse out-of-pocket medical, dental, or vision expenses allowed by Section 213D of the IRS Code for eligible individuals. And also in the IRS regulations, there are non-discrimination rules under Code Section 105H, which we will touch on briefly on the next slide. The second main body of rules that govern HRAs is ERISA. As a group health plan, the HRA is required to have a plan document. That plan document needs to be adopted by the employer. Generally, the plan document is adopted by some action taken by the governing board of the company or a similar entity that is authorized to act on behalf of the employer. In the case of a sole proprietorship, that entity is basically the owner who adopts the plan document. Also, an HRA needs to have an SPD, a summary plan description, which is updated with the current HRA plan description and distributed to participants. I think just briefly, one question we often get is whether the SPD can be distributed electronically to participants, and that is permitted in some cases. The SPD can be distributed electronically to participants who have access to computers while at work. ERISA claims and appeals rules also apply to HRAs, as well as Form 5500 reporting requirements if the plan has over 100 participants. COBRA also applies to HRAs as well. I think one important thing to note is the question of premiums for HRAs. Premiums can be charged for the HRA. I think oftentimes employers aren't even aware of the fact that they can charge a premium for COBRA HRA, and oftentimes they will basically just include the HRA with the COBRA premium for the medical plan. But the COBRA premium can be charged for the HRA, and once it is in fact charged, the question is, what is the value of the premium of the COBRA premium for the HRA? And there's different methods to decide what premium should be charged to COBRA beneficiaries regarding the HRA. I think the utilization method is the most common method for charging a premium for the HRA. Essentially, that looks at, on average, how much of the HRA is being utilized by plan participants, and that is what is charged for coverage under the HRA. And finally, we're going to talk about it in some upcoming slides, but the ACA, the Affordable Care Act, health care reform, also governs HRAs as well, so we will talk about that. Again, as I mentioned on the previous slide, there are non-discrimination rules as they apply to HRAs, and those rules are in IRS Code 105H, which presently apply only to self-insured plans. They are scheduled at some point to apply to fully insured plans as well, but for our purposes in this discussion, 105H governs HRA plans, and essentially what 105H says is the HRA cannot discriminate in favor of highly compensated employees as to eligibility or benefits. Maximum reimbursement cannot be based on compensation, age, or years of service. I think the bottom line to take away from this is that if you are treating all employees the same as they apply to eligibility and benefits, if you are treating all employees the same, then you really shouldn't have an issue with the discrimination rules. Now, the IRS does approve certain classifications that you can discriminate against, and those classifications are based on objective business criteria, which the IRS has specifically said is allowed, and those types of classifications would be full-time versus part-time or geographic location. So if you want to have different eligibility, different waiting periods, or different benefits for groups that are considered reasonable classifications, then there's no problem with that. And that shouldn't have an effect on the discrimination rules. Another issue with HRAs is participation by owners and other potentially ineligible individuals. As with other IRS plans, owner participation is limited. Similar to cafeteria plans, C Corp owners may receive tax-free reimbursements, so C Corp owners can pretty much participate without any restrictions. On the other hand, S Corp owners, partners, LLC members, and self-employed individuals may not participate on a tax-favored basis. That's slightly different from the cafeteria plan rules, where this group of individuals, it's basically a blanket prohibition that those individuals can't participate. However, for HRAs, this group of individuals, again, S Corp owners, partners, LLC members, and self-employed individuals, may participate if it's on a taxable basis. So those individuals must be taxed on the value of coverage. Again, just like determining a COBRA premium, sometimes it's difficult to determine what exactly the value of that coverage is. But once it is determined what the value of that coverage is using some maybe a utilization standard for determining a COBRA premium, once that premium is calculated and is imputed to the income of these owners, they can get reimbursements tax-free. So they are able to participate in the plan as long as their coverage is taxed to them as income. A similar analysis applies to other individuals that are ineligible for tax-free coverage and reimbursements under the plan, and that applies in some cases to domestic partners who are generally not eligible to receive tax-free coverage. They too can participate if it is done on a taxable basis. Another compliance requirement for HRAs that began in 2011 is MSP reporting, and MSP is Medicare Secondary Payer. And the Medicare Secondary Payers payer rules are basically in place to assure that Medicare coverage is secondary and not primary to group health plan coverage. So the MSP rules essentially state that in most cases, if an individual is covered by a group plan and covered by Medicare, that the group plan should pay expenses first, and then anything that isn't covered by the group plan could be covered by Medicare. Well, one way that CMS, the Centers for Medicare and Medicaid Services, track the rules is through MSP reporting. So HRA plans, as group health plans, again, must report. They are not exempt from MSP reporting rules. The only exemption is for plans with an annual benefit of less than $5,000. But what's important to note is the reporting is done by a required reporting entity. So it's not necessarily the employer's responsibility to do the reporting. For a fully insured group plan, generally it's the carrier's responsibility. For an HRA that is administered by a third-party administrator, generally it is the third-party administrator's duty to actually do the reporting. And then only if there is a self-insured a plan would the duty fall on the employer to actually do the reporting. And so many employers that have a fully insured group plan and have an HRA that is administered by a third party may not even know about this requirement because it's the carrier and the third party that's actually doing the reporting. And that reporting is due quarterly with data for all covered individuals to ensure compliance with the rules. So now we jump into our first of the Affordable Care Act changes, which is the PCOR fee, Patient-Centered Outcome Research Fee. It's applicable to all group health plans, including HRAs, and that fee is effective for plans ending between October 1st of 2012 and October 1st of 2019. And essentially the fee is paid as an excise tax on IRS Form 720. It's a little confusing because the PCOR fee is an annual fee and Form 720 is actually a quarterly tax filing, but the PCOR fee is reported on the second quarter, Form 720, which is due July 31st of the calendar year after the end of the applicable plan year. So plan years that are ending in 2014, that fee is going to be due July 31st of 2015. The amount was $1 per covered individual per year for the first year in 2013 or 2014, whichever was the first year that applied to, depending on when the plan year ended, and then $2 from there on out until 2019 or 2020. And ProBenefits, what we do essentially is we calculate the PCOR fee, we determine the number of covered lives for our HRA clients, and we send this populated 720 to our HRA clients, and all they have to do is review the 720, sign it, and submit it with the check for the applicable amount to the IRS. So generally, we calculate the number of covered individuals and the amount and forward that information to the client. As many of you know, the ACA, the Affordable Care Act, has implemented a number of market reform rules for group medical plans, including a prohibition on annual or lifetime limits for essential health benefits. And that poses a particular problem for HRAs, since by definition HRAs have a limit on how much they pay out each year. But the IRS has confirmed that these particular market reform rules, specifically the prohibition on annual and lifetime limits, does in fact apply to HRAs. And so because of that, there are a number of things for HRAs to now take into account, and there are some particular plan designs that may no longer be compliant with the ACA rules, even though previously, before pre-ACA, they may have been a pretty good option for employers. And so what the guidance basically says is that HRAs now must be linked to a group health plan. And we will get in briefly on the next slide what linked is. But the only exception to the linked HRA rule is an HRA that only has retiree coverage, or an HRA that only reimburses dental or vision-only expenses, or in the rare circumstance where there is a plan that only covers a single participant. The guidance has confirmed that HRA plans cannot reimburse individual or market premiums tax-free. I know that's been a hot topic recently. And also, not only that, but the HRA cannot be linked or integrated with individual coverage in order to satisfy the market reform rules. So the bottom line then is that HRAs need to be linked, and they need to be linked with a group health insurance plan. And essentially what linked means is that all individuals that are eligible for the HRA are also eligible for the group health plan, and anyone enrolled in the HRA also needs to be enrolled in the group health plan. And there also needs to be a specific opt-out provision to allow an employee to opt out of HRA coverage at least annually at open enrollment. I think just generally, generally what to take away is that for HRAs that are already linked to a major medical plan, including our common plan designs of deductible reimbursement or co-reimbursement, there aren't really any significant changes from the ACA rules regarding linked plans. So those plans can essentially continue as is. But there is a major change for standalone plans and plans allowing reimbursement for individual insurance premiums. In the interest of time, I'll just go through this slide briefly, but again, I think what to take away from this slide is essentially the HRAs in the post-ACA world still provide value to employers who value whether it be in reducing cost or increasing flexibility for employees. So even after the Affordable Care Act and the various new rules, that HRAs still provide good value and can be used by employers. For 50-plus groups subject to the employer mandate, an HRA may be used to help meet the minimum value standard and also meet the affordability standard to help lower applicable premiums. Guidance is not quite clear yet on whether HRAs can help employers meet new out-of-pocket limits that apply to small and large groups. However, that issue is somewhat moot since the carriers are really only offering plans that are compliant with the out-of-pocket limits. And finally, I'll just touch on these briefly. All HRAs are also required to have a summary of benefits and coverage in SPC. But however, HRAs are not required to comply with the required contributions to reinsurance, the new W-2 reporting rules for group health benefits, and the information reporting under sections 6055 and 6056. In the interest of time, I know a lot of you have questions, but I'm going to turn it over now to Jamie, who's going to start talking about plan designs, and we can touch on the questions afterwards. Jamie?
Thanks, Chris. Appreciate the compliance update on HRAs. And for those of you attending this webinar, I think Chris and many of you know Jason Cogdo, our other benefits attorney. They are two of the distinct, they comprise one of the main distinctives of ProBenefits. So we do have two attorneys on staff, and very appreciative for all their compliance work on all of our employer clients and helping those that reach out to us for assistance. As we talk a little bit more about HRA plans, as Chris mentioned earlier at the beginning, I am one of our 3 benefits consultants here at ProBenefits. The other 2 are Kim Maliello and Charles Crabb. We are here to assist employers and brokers with questions regarding these type of plans, whether it be HRA plans that we're talking about today or FSA plans or HSAs. We're there as a resource for you all. And so when we talk more about HRA plans, what are the distinctives of HRA plans? Well, they allow for a maximum amount of employer flexibility. Employers can choose to reimburse a variety of expenses through an HRA plan, and as Chris mentioned, they are entirely employer funded. So the employer kind of gets to designate what the plan looks like, what's going to be reimbursed, all of that good stuff. Significant cost savings. You know, when we look at HRAs in the context of what insurance renewals are, a lot of times you can go to a lower cost insurance plan and supplement it with an HRA to help the employees, and the employer in the end game still saves money. It can be used, an HRA plan can be used with any health insurance plan. I think that's an important point, oftentimes lost in the pre-tax benefits discussion. You know, HSAs have to be linked to a certain health, have to be established with a certain type of health plan. HRAs can be used with any type of group health insurance plan. HRAs are a positive step towards a consumer approach for employers and employees, because you're now engaging the employees more in the cost of their services rather than just through a traditional insurance plan where everything is handled through the insurance carrier. An HRA, supplementing a group health plan with an HRA, actually exposes the employee to more of the costs that go into that health insurance. And HRA plans are very inexpensive for the employer. And as Chris mentioned, the key is flexibility. Flexibility, flexibility. We can't say that enough about HRA plans. Oftentimes in the sales world that myself and Charles and Kim are in, when we're talking to brokers, advisors, and employers, we're oftentimes asked about, you know, what are the hot topics of the day regarding, in this case, HRA plans. You know, what are the current trends that we're seeing? As Chris has already discussed, one of the big topics of discussion over the past 6 months to a year has been the fact that there are no longer standalone HRAs if they include any type of medical expense reimbursement, because those HRAs, as Chris talked about, have to be tied to a group health plan to satisfy some of the Affordable Care Act provisions. This has had a negative impact on a lot of small employers who've had no group health plan but have been giving their employees some tax-free benefits through an HRA for out-of-pocket medical expenses, and in some cases individual insurance premiums. As a matter of fact, I just talked with an employer on last Friday, had this discussion, and the employer said, do you realize how much of a tax hit this is for us, that now in order to help our employees with their individual health insurance, we're just going to have to do it through taxable compensation. It's a tax hit in the tens of thousands of dollars for us, and I recognize that, and we recognize that. But unfortunately, the rules are what they are, and so standalone HRAs have gone by the wayside if they include any medical expense reimbursement. Deductible reimbursement HRAs still account for the vast majority of our plan designs that we talk about and that we see in-house for clients that we administer their HRA plans. Most of them are still deductible reimbursement plans, and these plans vary greatly in reimbursement structure. They may reimburse deductible expenses on the front end, on the back end, on the front end, back end, and the middle. Percentage-wise, again, flexibility is the key there, and they vary greatly in amounts. The HRA plan design is very dependent upon specific employer objectives. The employer, once they look at what their group health plan renewal premiums are and some different options, that oftentimes drives the boat in terms of how we're going to structure the HRA plan and what we're going to reimburse as the employer. Deductible reimbursement plans are actually a valuable tool for many employers that have already gone the HSA eligible health plan route. Those HSA eligible health plans, the deductibles are increasing to navigate the renewal process, and so you can use a back-end deductible reimbursement on an HSA eligible health plan to help employees with those higher deductibles and also maintain HSA eligibility. So deductible reimbursement plans are great tools even for employers that have already gone to HSA eligible health plans. Other things that we're seeing right now, along with the deductible reimbursement, we are certainly seeing employers want to expand beyond the deductible reimbursement plan and reimburse maybe for co-insurance expenses, and even other components such as prescription reimbursements. That's becoming more popular as well. And these examples here on this slide, I'm going to go through some concrete examples in later slides of specific type plan designs. If a plan is reimbursing for co-insurance or expenses applied to co-insurance after the deductible has been met, those plans are certainly more complex now from the administrative angle and from the employee angle, because as many of you know, now our health plans, our non-grandfather health plans are now looking at deductible and out-of-pocket max, no longer deductible and co-insurance max. So if an employer is only wanting to reimburse for big ticket items applied to co-insurance, The coinsurance reimbursement part of the plan certainly is more difficult as we move forward, but we still have quite a few of those plans on the books here at ProBenefits. There are also full 213D HRA plans where really a full-blown HRA plan where the employer just offers employees a bucket of money, and we're going to talk more about that in a bit. And these are becoming increasingly utilized as a valuable employee benefit. And these type HRAs, these full-blown HRAs, can be used for an employer as an alternative to HSAs or contributions on the employer side. So you might have an employer that has gone to an HSA-eligible group health plan. They might not really, they want to fund their employees some money, but they don't really like the idea of putting money into an HSA and that money being 100% vested and walking with the employee if they ever leave employment. So they could choose to go the HRA route. We actually do that here at ProBenefits. Expenses can be restricted to one category, such as a dental only or a MERP type design. Again, we're going to talk a little bit more about that, and Chris already touched on that earlier. And then retiree HRA plans. We're talking a lot more about those. They're on the rise in an effort for employers to control retiree cost. So those are kind of the topics that we're talking about a lot these days. So just want to run through a few kind of concrete examples of these different type of plan designs. First is a deductible reimbursement plan with a copay reimbursement component. Typically, a deductible reimbursement plan is paired with a mid to high deductible group health plan, and the employer just says, okay, employee, I'm going to self-fund a portion of this higher deductible. Oh, and by the way, I'm also going to help you with a portion of one of your categories of copays on your health plan. And so a basic example of this is, let's say we had an old health plan with a $1,500, $3,000 deductible, a $1,500 for employee only, $3,000 for family, and then a $50 specialist visit copay. Now, employer gets their renewal back. It's terrible renewal, so they're looking at options, and they settled upon going to a $2,500, $5,000 deductible plan with a $75 specialist visit copay. So what the employer could do there, they could certainly go in and help the employee with that higher deductible, maybe reimburse the last $1,000, $2,000 of that deductible, where the employee is responsible for the first $1,500, HRA reimburses the last $1,000. And then they could even set up a component where, hey, employee, we're going to reimburse you $25 of that new $75 specialist visit copay to get you back down to the old $50 copay amount. And certainly the employer can put a cap on that copay reimbursement. Maybe they want to do a max of $200 for the year or whatever that may be. Some employers don't put a cap on it at all. But that's just kind of a basic example of one of the new type plan designs or expanded type plan designs that we're talking about now. Now, a more advanced example of that same design option is, let's say that the group health plan, old health plan was $1,000, $2,000 deductible, and then we had a $2,000, $4,000 coinsurance max, and then we had a prescription drug card of $10, $35, $50. Again, get hit with a substantial renewal, as a lot of employers are right now, and so we decided to bump that deductible up to $2,000, $4,000. Now we've got a $3,000, $6,000 out-of-pocket max. And then on the prescription end, we have a $10 generic copay, but then the employee has to pay 50% of the cost of all other drugs, all brand name drugs, up to a $100 max. So the employer in that situation could say, okay, well, I want to establish an HRA to help my employee with the deductible. I also want to help them with, once they've met that deductible, if they have big ticket items that are applied to coinsurance, I also want to help them with that. And, oh, by the way, I also want to help them with any prescription drug cost over $50. Maybe they reimburse the employee dollar for dollar for any prescription drug over $50. So that's definitely a more advanced example of kind of the same design option. And as Chris mentioned earlier, the key is flexibility. I've mentioned it as well. HRA plan designs can take on a variety of forms. So whatever the employer objectives are, we can typically accommodate those for those within administrative constraints. What can and can't be done. We can try to accommodate for those. Employee education is important with these HRA plan designs, along with administrator. Whoever you're using is the administrator for the HRA. Along with their flexibility in accommodating different types of plan designs and the available resources that they have for the employees. Moving forward, we've already mentioned this one, the full 213D HRA. We are talking a little bit more about those as well. Again, employer says, employee, we've got your group health plan, we're having to raise some deductibles, all that good stuff, but what we're going to do is, employee, we're just going to give you a bucket of money, and you can use that bucket of money for any out-of-pocket medical, dental, vision expense. Example, $1,200. So an employer just says, I'm going to give each of my employees that are enrolled on the group health plan a $1,200 bucket of money to use for any out-of-pocket expense. There are significant unique plan options within these type of designs. The plans can allow expenses to be incurred, submitted anytime. There doesn't have to be a plan year limitation requirement. Certainly, I think for planning purposes, it's typically good to have a plan year requirement on an HRA or a plan year structure. But it's not required per the IRS rules. Also, carryover of HRA funds is allowed. So if you're giving employees this bucket of money, you can allow them to carry it over to future years. You can allow them to carry over all the dollars or restrict it to a certain amount or a certain percentage of what they have left. So carryover is a nice feature. And then the advanced consumer-driven healthcare model, an HRA like this with carryover paired with a health FSA. Flexible spending account. That serves as a little bit of an alternative to HSAs for employers that don't like the idea of HSAs if they've gone the route of a high deductible health plan. There's also the MERP option, which again we've seen a few of these over the past year. Simple concept, basic plan design, medical expense reimbursement plan. The employer just says, I want to help my employees, give them a bucket of money for a certain category of expenses. And that could be for vision or dental. I know one plan I worked on last year was the employer's given each employee a bucket of like $300 for dental expenses. It can certainly replace a dental plan or a dental plan offering. Again, if you do a MERP and you define the category to a medical expense, then the MERP has to be linked to participation in the group health plan. But if we have a dental or vision or retiree benefit, it does not have to be linked to a group health plan. And again, carryover can be allowed, and that's a nice feature for employees. Then another hot topic over the past year has seemed to be retiree HRAs. As you can imagine, employers that have promised retirees certain benefits after they retire in terms of health insurance and that kind of thing, the costs are becoming astronomical. So now employers are using retiree HRAs to manage rapidly rising costs and to control future employer liability. And in this scenario, the employer just provides each retiree with a bucket of money for any out-of-pocket medical, dental, vision expense, plus allows them to use that money for individual health insurance premiums. Again, retiree plans can do that. Example would be just giving retirees a bucket of money of $8,000 a year that they can choose to use how they want to. Again, this helps to define employer liability in future years versus just telling retirees, I'm going to pay for your health insurance for the duration of your retirement. This kind of defines that liability. That exposure for the employer. Carryover of HRA funds is allowed again, and this seems to be a popular thing to do in conjunction with a private exchange established by an employer for health plan options for those retirees. In terms of our ProBenefits, our HRA administration here in our office, I'm just going to read, just kind of recap or read through these really quickly because I think we bring to the table some important distinctives for employers considering HRA plans and advisors as you talk with your clients. Expertise in employee education at setup, that's what myself and Charles and Kim in our office, we're your resources on the front end for HRA plan designs and setups with employers. And then efficient claims and reimbursement processes, full admin and compliance support. Each of our employer clients has a dedicated admin point of contact here at ProBenefits that the HR person at that company knows. I need to call Vicky or Jesse or Amanda or whoever the admin may be on our end. They've got that one-on-one point of contact, which I think is a huge benefit in the benefits world that we live in right now. Compliance support, I've already talked about Chris and Jason and how excellent they are. our attorneys prepare the legal docs, the SBCs. We do the P-Corps fee preparation, the paperwork preparation, as Chris talked about, MSP reporting. Detailed reporting is available to employers to kind of see what employees' exposure, what their exposure on the HRA plan has been for the year, all that good stuff, and that helps make decisions for future years. Our admin cost is very low compared to time and expense involved in self-administration. Obviously, employer administration, if you decide you want to put an HRA plan but you want to do it in-house, it's much more complex now with the variety of rules that have come about, whether it be MSP reporting or P-Corps fee preparation or whatever that may be. The cost to use somebody like us greatly is much less than the time cost to you, the employer, to self-administer these things. Also, a lot of carriers offer in-house HRA products. You know, those are typically not portable from carrier to carrier, and as you know, employers are switching carriers a lot of times in this day and age. Also, carrier products are very boilerplate options. They're not able to be customized, whereas coming to an independent third-party administrator like ourselves, we're able to customize those based on the employer objectives. And carrier products typically have little compliance and customer support. And we as a company overall, and the way we administer HRA plans through setup and administration, we just help employers advance the concept of health consumerism with our HRA plan administration. Again, carrier integration is convenient, but does not expose employees to the true cost or help in that consumer mindset. I hope that's helped with going through HRA plan designs. This slide we include as just some additional resources for you as the employer that you have available to you. You know, certainly we are here for information on any HRA or benefits topic that you might have. We're going to have further updates and webinar sessions to come. The next one is scheduled for November 12th, which will be an update on Section 125 plans and FSA. There is a comprehensive government site on the Affordable Care Act. We list that here for you. And then us here at ProBenefits to be a resource for you for admin for HRA, FSA, HSA, COBRA, premium-only 125 plans. We do Form 5500 prep for health and welfare benefits, healthcare reform education led through Jason here in our office. I have mentioned Charles and Kim, our other benefits consultants, along with me here. We want to be resources for you as well as you navigate these decision-making processes. And then we have Jason and Chris on staff as excellent resources for you, the employer.
Thanks, Jamie. I know many of you, it's 11:45. That was our schedule. Anytime may want to run off to lunch. So thanks very much for attending. And again, as I said at the beginning, all these webinars are emailed to the attendees probably in the next day or so with the slides, and we should have a recording as well with the audio. And so for those of you that have to go, feel free to go. We will stick around a bit for a few questions if you have any. I think we did a good job of answering the individual questions that were asked. We responded to many of them during the presentation, but if any more come in, we will stick around for another couple of minutes. I know we have one question that says, I thought domestic partners were now eligible for pre-tax benefits, and that goes back to their eligibility to participate in the HRA. As many of you know, the Supreme Court in the Windsor decision struck down the Defense of Marriage Act's definition of marriage as between one man and one woman, and what that has meant here in the benefits world, and that for federal tax purposes, same-sex spouses can now participate in cafeteria plans, HRAs, on a tax-free basis. And I think it's important to distinguish between same-sex spouses and domestic partners. Domestic partners whether same-sex or opposite-sex, it doesn't matter, are still ineligible to participate on a tax-free basis. As we talked about, they can potentially participate on a post-tax basis if the plan allows, but domestic partners, again, same-sex or opposite sex, who are not legally married, are still not eligible to participate on a tax-favored basis. However, if the plan allows, same-sex spouses who are actually legally married, were legally married in a state that performs same-sex marriages, they can in fact participate on a pre-tax basis. So I think it's important to note the distinction between same-sex spouses and domestic partners for that purpose. Jamie, we have a question. Maybe you can just touch briefly again on how an HRA, whether they can also have an HSA, and how that might work with an FSA as well.
Yeah, thanks, Chris. So yes, the question, I see the questions come in. We have an HRA and an FSA, or a flex plan. Can we also have an HSA that only the employee contributes to? Keep in mind that in order for employees to have HSAs, you have to have a certain type of health plan design. You have to have a health plan that has a certain high deductible, meets certain requirements, and then the health plan can have no first dollar coverage. So you can't have any copays for anything in the health plan until after the deductible has been met. So for a lot of employers, they haven't gone down that road yet. They haven't been willing to make the jump to a health plan that doesn't have copays for standard services like primary care visits and those kind of things. But for the employer that has made that jump, and you've got the required health plan, if you have an HRA and a flex plan with flexible spending accounts, then in general terms that makes the employee's HSA ineligible, particularly if the HRA reimburses expenses below the HSA required deductible amount on the health plan. So you can certainly have an HRA that reimburses the back end of the deductible and protects the HSA qualifying deductible amount, and then have HSAs and this back end deductible reimbursement HRA. But again, if you've got flexible spending accounts, a full-blown health flex spending account disqualifies employees from being able to contribute to an HSA. So I think if you're in that situation, certainly we'd be more than happy to talk with you about the implications there. But if you've got both an HRA and flexible spending accounts, your employees are probably ineligible to contribute to an HSA.
Thanks, Jamie. I think in the interest of time, I know there's a couple questions just popping in right now, but I think we'll sign off the audio and for now, and if there are any other questions that are still out there, we will respond directly to the individual. But for the interest of time, we will head off. Thanks again, Jamie, for your help and presentation, and again, we will respond to any other questions that may have popped in the last few seconds. Again, thank you, and have a good day.